Welcome, curious minds, to another deep dive. Today we're tackling a topic that, let's be honest, many approach with a bit of dread, your 2024 tax forms. But I promise, once you get the hang of it, you'll see it's actually full of, well, intriguing details and hidden opportunities. Think empowerment, not chores. Our mission today: demystify the IRS instructions for Forms 1040 and 1040 SR.
That's exactly right. We're going line by line, practically speaking, not just to figure out how to fill things out correctly, but really digging for those nuggets, the things that can actually save you money, reduce your tax bill. Think of this as, your shortcut, getting informed about your responsibilities and finding those benefits you might otherwise miss.
Okay, so first things first, a really basic question. Do I even need to file? Because it's not automatic for everyone, is it?
Not at all. For 2024, there are specific income levels, thresholds based on your filing status.
Right, like if you're single, under 65, what's the number?
It's $14,600. If your gross income is below that, you generally don't have to file, but that number changes quite a bit. Age matters, marriage matters.
So for married couples filing jointly?
Much higher. If you're both under 65, it starts at $29,200. Goes up if one or both are 65 plus. But then, look at married filing separately. That threshold can be, believe it or not, just $5.
$5, wow.
Yeah. So the point is, these thresholds filter out people below a certain income. You can always find the exact figures for your situation on irs.gov.
Okay, but what if your income is below those levels? Are there times you still absolutely have to file?
Yes, definitely. This trips people up. Even with low income, you might need to file. For instance, if you had net earnings from self-employment, say freelance work, of $400 or more, you have to file.
Ah, okay. Important for gig workers.
Very important. Also, if you got those advance payments of the premium tax credit for health insurance through the marketplace, often on a Form 1095A,
Yeah.
you must file to reconcile those. If you don't, you'll probably get a notice, maybe a bill from the IRS later.
Yeah.
And maybe the most important reason, refundable credits. Things like the Earned Income Credit, the American Opportunity Credit, the Additional Child Tax Credit.
These can actually get you money back, right? Even if you don't owe tax.
Exactly. They're fantastic, but you absolutely have to file a return to claim them. No filing, no credit. Oh, and there are special rules for dependents, too, involving earned versus unearned income. So, yeah, plenty of reasons to file, even below the main thresholds.
Got it. So once you know you need to file,
Yeah.
when and how? The deadline is usually April 15th, right? So April 15th, 2025 for the 2024 return.
That's the one. Miss it. And you're looking at potential interest and penalties. Not fun.
But what if you just need more time? Life happens.
Absolutely. You can get an automatic 6-month extension to file. You just need to submit Form 4868 by April 15th. But here's the really crucial part. It's an extension to file, not an extension to pay.
Ah, good distinction.
Yeah. If you think you'll owe money, you still need to estimate that amount and pay it by April 15th. Otherwise, those penalties and interest start kicking in on the unpaid amount.
Okay. And how should people actually submit the return?
The IRS really, really pushes electronic filing, or e-file, and for good reason. It's generally faster, way more accurate, because the software does the math, and it catches common errors before they even happen.
Makes sense. What about free options? Always a popular question.
Lots of good ones. If your adjusted gross income, your AGI, is below a certain amount, you can use IRS Free File. That gives you access to free brand name tax software. Then there's IRS Direct File. This is becoming permanent in 2025 for folks with simpler returns in participating states. You file directly with the IRS securely for free.
Direct file. Okay.
Any others? Yep. If you're comfortable doing taxes yourself but want electronic filing, there are free fillable forms, basically electronic versions of the paper forms. And for people who need more direct help, there's VD Volunteer Income Tax Assistance and TCE Tax Counseling for the elderly. These are amazing community programs offering free basic tax prep for qualified folks, lower income, people with disabilities, limited English speakers, really valuable resources.
Great. So let's move on to the form itself, Form 1040. Those first few lines, name, address, social security number, seems basic, but accuracy here is key, right?
Absolutely critical. Your name and address need to be correct and match what the IRS has on file. There are specific instructions, too, like if you're incarcerated, you include your inmate ID. If married, filing separately, you list your spouse's name. And the social security number, triple check it. A wrong digit is one of the fastest ways to delay your refund or even have it reduced.
What about people who don't have an SSN?
They'd use an ITN, individual taxpayer identification number. And just a heads up, some ITNs need renewal if they haven't been used on a tax return in the last few years, specifically 2021, 2022, or 2023.
Okay. And that little box for the presidential election campaign fund, does checking it cost me anything?
Nope, not a dime. Checking that box allocates $3 of existing federal funds. It doesn't change your tax or your refund amount at all.
Good to know. What about this identity protection PI, the IPPI? I hear more about that now.
Yes. This is a big deal for security. It's a 6-digit number the IRS issues yearly, and all taxpayers are now eligible to get one voluntarily. It's a fantastic tool to prevent identity thieves from filing a fake return using your info. You enter it when you e-file, adding an extra layer of validation. Highly recommended.
And a quick, practical tip, rounding numbers.
Oh yeah, simple rule. Less than 50 cents, drop it. 50 cents or more, round up to the next whole dollar. Makes the math a bit cleaner.
Okay, moving on. Filing status. This feels like more than just checking a box. It seems strategic.
It absolutely is. Choosing the right filing status can significantly change your standard deduction, your tax brackets, your eligibility for credits. It's a cornerstone of tax planning and saving.
So let's break it down. First, married filing jointly. Who qualifies?
Generally, if you were married as of December 31st, 2024, or if your spouse passed away during 2024 and you didn't remarry before year end. Even if your spouse died in early 2025 before you filed your 2024 return, the big benefit. Combining income and deductions often leads to the lowest tax bill for a couple.
But there's a catch, right? Something about liability. The big one, joint and several tax liability. This means both spouses are 100% responsible for all the tax, interest, and penalties on that joint return. Doesn't matter who earned the income. If there's a tax debt, the IRS can collect the full amount from either spouse.
Okay, that's serious. Which leads us to married filing separately.
Exactly. Here, each spouse files their own return, reporting their own income, deductions, and credits.
Why would someone choose this, though? If filing jointly usually means less tax.
You're right. Filing separately often results in a higher total tax bill. You lose out on a lot. You generally can't take the student loan interest deduction or education credits. Your ability to claim the earned income credit or the child independent care credit is severely limited or eliminated. And here's a big one. If your spouse itemizes deductions, you cannot take the standard deduction. You have to itemize too, even if your itemized deductions are tiny.
So it's rarely a tax saving. Almost never. The main reasons are usually non-tax. Maybe you suspect your spouse isn't being truthful about their income, or you want to shield yourself from liability for their potential tax debts. If you are in a situation where you filed jointly but feel you shouldn't be held liable for your spouse's tax errors or fraud, there's something called innocent spouse relief. You'd file Form 8857 to request that.
Good to know about.
Yeah.
Okay, next, head of household. This seems really important for single parents.
It's huge. It provides a larger standard deduction and more favorable tax brackets compared to filing as single, a real tax advantage. The main requirements. You need to be unmarried or considered unmarried for tax purposes. That often means living apart from your spouse for the last 6 months of the year. You also need to have paid more than half the cost of keeping up your home for the year. And a qualifying person, usually your child must have lived with you for more than half the year. There are some exceptions and specific rules, like for claiming a dependent parent who doesn't live with you, or for kids of divorced parents.
Got it. And the last one, qualifying surviving spouse.
This is a really valuable status, often overlooked. It used to be called qualifying widower. If your spouse died in 2022 or 2023, you haven't remarried by the end of 2024, and you have a dependent child or stepchild living with you that you support.
Yes.
You can use the favorable married filing jointly tax rates and standard deduction for up to 2 years after the year your spouse died. It's a significant tax saver, offering a financial cushion during a difficult time, preventing an immediate jump to less favorable rates.
All right, let's dive into income. The basic rule seems simple. Pretty much everything is taxable unless the law specifically says it isn't. But the exceptions and nuances. That's where the tax saving happens, right?
Precisely. Understanding what counts, what doesn't, and the choices you sometimes have. That's key. So first, standard stuff. Wages, salaries, tips. Mostly from your Form W-2. Pretty straightforward. One small note, if you earn wages as an inmate, that actually goes on Schedule 1, Line 8U, not the main wage line.
Okay. What else?
Here's an interesting one. Medicaid waiver payments. These are often paid to you for caring for someone in your home under certain state programs. These payments might be excludable from your income, meaning non-taxable. But check this out. You can choose to include these otherwise non-taxable payments in your earned income.
Why would you choose to pay tax on something you don't have to?
Great question. Because having earned income might qualify you for certain valuable credits, like the Earned Income Credit, or allow you to contribute to an IRA. So including that income could potentially lead to a bigger refund or tax benefit overall. It's a strategic choice.
Wow. Okay. That's a specific tax-saving opportunity.
Right.
Any others like that?
Yes, non-taxable combat pay. If you received tax-exempt combat pay, you can elect to include it in your earned income only for calculating the Earned Income Credit, EIC. Again, this doesn't make the combat pay taxable for regular income tax, but including it for the EIC calculation could significantly increase that refundable credit, another potential refund booster.
Very clever.
Yeah.
What about investment income, like dividends?
Big difference here between qualified dividends and ordinary dividends. Qualified dividends get taxed at lower capital gains rates, much better than ordinary income rates. But there's a catch the holding period. To be qualified, you generally need to hold the stock for more than 60 days during the 121-day period that starts 60 days before the ex-dividend date.
Okay, can you give an example?
Sure. Let's say you buy XYZ stock on July 8th. The ex-dividend date is July 16th. You sell the stock on August 11th. Even though you got the dividend, you only held the stock for 34 days during that key period, not long enough. So that dividend is ordinary, taxed at your higher regular rate, not the lower qualified rate. Details matter. And remember, if your total ordinary dividends are over $1,500, you'll need to file Schedule B.
Got it. How about withdrawals from retirement accounts, like IRA distributions?
Well, first, simple rollovers from one IRA directly to another usually aren't taxable. That's just moving money around. But here are two major tax-saving strategies for folks over 70 and a half. One, qualified charitable distributions, QCDs. You can have money sent directly from your traditional IRA to a qualified charity up to $105,000 for 2024. That amount is excluded from your gross income. It's not taxed, and it counts towards your required minimum distribution, RMD, if you have one. Huge benefit for charitable giving.
Excluded entirely. That's powerful.
It really is. Two, health savings account, HSA, funding distributions, HFDs. This is a one-time chance in your lifetime to make a trustee-to-trustee transfer from your IRA to your HSA. That transferred amount is also excluded from income. Another great tax-free way to fund healthcare costs. Of course, you still have the usual rules about potential penalties for early IRA withdrawals before 59 and a half and the requirement to take RMDs starting at age 73.
Okay. What about pensions and annuities?
Similar idea. You need to figure out the taxable portion. There are methods like the general rule or the simplified method, but here's a specific tax saver for retired public safety officers, police, firefighters, EMTs. Eligible retirees can exclude up to $3,000 of distributions from their government retirement plan if they use that money to pay for qualified health or long-term care insurance premiums for themselves, spouse, or dependents. A targeted benefit.
Good to know. Social Security benefits, can those be taxed?
They can be, yes. Depending on your total income, including the Social Security, a portion up to 85% might be taxable. There's a worksheet to figure it out. One potential tax-saving tip here, if you received a lump sum payment of benefits that included amounts for earlier years, check out the lump sum election detailed in IRS Publication 915 and might let you figure the tax on the earlier year's portion using that year's income, potentially lowering the tax impact in the current year.
Interesting. And finally, capital gains or losses. Selling stocks, property.
Generally, yes, that requires reporting on Form 8949 and Schedule D. You calculate your gains and losses there. There is a simpler exception, though. If your only capital gains are capital gain distributions shown on Form 1099 DIV and you don't have any capital losses to report, you might be able to report the gain directly on Form 1040 without filing Schedule D. But most sales require Schedule D.
Okay, that covers the main income lines. What about Schedule 1, Part IA, other income?
Right. This is for additional income types not listed directly on the main form. And there's a really important update regarding Form 1099-K.
The one from payment apps and online marketplaces.
Exactly. The reporting threshold was supposed to drop drastically, but it got delayed again. For 2024, the threshold is $5,000. It's planned to drop to $2,500 for 2025 and then $600 for 2026. But here's the critical part for anyone getting a 1099-K. What if it includes money that wasn't actually business income, like you sold personal stuff online at a loss? Or maybe a friend reimbursed you for dinner via an app?
Yeah, that happens all the time. How do you handle that so you don't pay tax on it?
Great question. You need to make an adjustment. On Schedule 1, you report the amount from the 1099-K, but then you make a corresponding negative entry on Schedule 1, Part 1, Line 8 says, labeling it something like Form 1099-K personal item sold at loss or Form 1099-K reimbursement. For example, you sold your old couch online for $700. It originally cost you $1,000. That $700 might show up on a 1099-K. You'd list the $700 income, but then subtract $700 as a negative adjustment for the loss on a personal item. Net effect: zero taxable income from that transaction. You must do this adjustment to avoid overpaying tax.
That is super helpful. A lot of people will need to know that. Anything else notable on Schedule 1 income?
A couple of things. Digital assets, crypto, NFTs. If you earned ordinary income from things like staking, mining, or maybe an airdrop or hard fork, and it wasn't reported elsewhere, like on a 1099 MISC, you'd report it here on line 8V. Importantly, though, you don't report gifts or inheritances of digital assets here. Those have different rules. Also, for folks working overseas, the foreign earned income exclusion and housing exclusion on line 8D can be huge tax savers, potentially excluding over $100,000 of income. And a fun one: non-taxable Olympic-Paralympic medals prize money. Line 8 meter. Excludable if your AGI is under $1 million. $500K if married filing separately.
Okay, let's shift gears to adjustments to Income Schedule 1, Part 2. These are often called above-the-line deductions. Why is that term important?
Because they reduce your gross income to arrive at your adjusted gross income, or AGI. Lowering your AGI is powerful. It doesn't just reduce your taxable income directly, it can also help you qualify for other deductions and credits that have AGI phase-outs or limitations. It's like a double benefit sometimes.
Gotcha. So what are some key adjustments people should look out for, potential tax savers here?
Definitely. First, educator expenses, line 11. If you're an eligible K-12 educator, you can deduct up to $300 of unreimbursed expenses: books, supplies, and notably, this includes things like personal protective equipment, disinfectants, air purifiers bought for COVID prevention in the classroom. If you and your spouse are both educators filing jointly, you can deduct up to $600 total.
That's helpful. What else?
The Health Savings Account HSA deduction, line 13. If you contribute to an HSA, those contributions are deductible here. It's a fantastic way to save for healthcare costs tax-free. Moving expenses, line 14, are now very limited, only for active duty military members moving due to a permanent change of station. For the self-employed folks, the deductible part of self-employment tax, line 15, is a key deduction. You calculate your self-employment tax and then you get to deduct half of it here.
And another one for the self-employed health insurance.
Yes, a really big one, the self-employed health insurance deduction, line 17. This lets you deduct premiums paid for health, dental, and qualified long-term care insurance for yourself, your spouse, and your dependents. And here's a nuance often missed. It also covers premiums for your child who is under age 27 at the end of 2024, even if they aren't your dependent. This can be a massive tax saving for entrepreneurs and freelancers.
Oh, okay. What about retirement savings? The IRA deduction, line 20.
Right. Contributions you make to a traditional IRA are often deductible. However, if you or your spouse are covered by a retirement plan at work, like a 401k, your ability to deduct traditional IRA contributions might be limited or phased out depending on your AGI. For 2024, the phase-out ranges are higher. For singles covered at work, it's between $77,000 and $87,000 of modified AGI. For joint filers where the contributing spouse is covered, it's $123,000 to $143,000. If one spouse is covered but the other isn't, the non-covered spouse has a much higher phase-out range, $230,000 to $240,000. Good news, though, that non-taxable combat pay we mentioned earlier does count as compensation for IRA contribution purposes.
Okay. And finally, student loan interest deduction, line 21.
Yep, you can deduct the interest you paid on qualified student loans up to a maximum of $2,500 per return. This also has AGI phase-outs. For 2024, it starts to phase out for single filers above $80,000 and is gone at $95,000. For joint filers, it's $165,000 to $195,000. One key restriction: you can't claim this deduction if you could be claimed as a dependent on someone else's return.
So we've calculated AGI after those adjustments. Now we get closer to the bottom line. Figuring the actual tax and applying credits. First big decision. Standard deduction versus itemized deductions, line 12.
Simple rule: you take whichever is larger. The goal is to subtract the biggest possible amount from your AGI before calculating tax.
And what are the standard deduction amounts for 2024?
They went up again for inflation. Single is $14,600. Married filing jointly is $29,200. Head of household is $21,900. Married filing separately is $14,600, same as single. And remember, those amounts get bigger if you or your spouse are 65 or older or blind. There's an additional amount per person, per condition. For single HOH, it's $1,850 extra. For others, $1,500 extra.
But that caution for married filing separately still applies.
Absolutely. If you file separately and your spouse itemizes, your standard deduction is zero. You're forced to itemize too, even if you have nothing to itemize. Coordination is essential there.
Okay, so you take your AGI, subtract the bigger standard or itemized deductions.
Yeah.
That gives you taxable income. How do you figure the tax on that, line 16?
Two main ways. If your taxable income is less than $100,000, you just look up the tax in the tax table in the instruction booklet. Find your income range, find your filing status column, boom, there's your tax. If your taxable income is $100,000 or more, you can't use the table. You have to use the tax computation worksheet, also in the instructions, or let your tax software do it. It applies the tax brackets to calculate the tax.
And then we get to the really good part. Credits. These are awesome because they cut your tax bill dollar for dollar, right?
Even better than deductions, and some are refundable, meaning they can give you money back even if your tax bill was already zero. Huge potential here.
Let's hit some key ones. The Earned Income Credit, EIC, line 27.
The big one for low to moderate income working families and individuals, it's fully refundable. Eligibility depends on your income, filing status, and how many qualifying children you have. Those kids need valid SSNs and must live with you more than half the year. One important heads up. The IRS is required by law to hold refunds for returns claiming the EIC or the additional child tax credit until mid-February. So file early, but don't expect that specific refund right away in January, mid-February 2025 at the earliest.
Good reminder. And that additional child tax credit, ACTC, line 28 you mentioned.
Also refundable. It's the refundable portion of the child tax credit. Same mid-February refund hold applies.
What about education? The American Opportunity Credit, AOTC, line 29.
Fantastic credit for undergrad expenses. Up to $2,500 per eligible student, and up to 40% of it, $1,000, is refundable. Here's a potential tax saving strategy. If the student received tax-free scholarships or grants, like a Pell Grant, you might be able to strategically choose to include some of that grant money in the student's taxable income. Why? Because it frees up more qualified expenses to be used for the AOTC calculation, potentially maximizing the refundable part of the credit. Requires careful calculation, but can pay off.
Interesting tactic. Okay. The Premium Tax Credit, Schedule 3, line 9.
This helps pay for health insurance bought through the Affordable Care Act marketplace. It's refundable. You reconcile the advance payments you received based on estimated income with the actual credit you qualify for based on your actual income using Form 8962. If you qualify for more credit than you received in advance, the difference is added to your refund.
And the Saver's Credit, Schedule 3, line 4.
Officially, the Retirement Savings Contributions Credit. This one is non-refundable. It gives you a credit for contributing to an IRA or workplace plan like a 401k. Eligibility is based on fairly low AGI limits, $38,250 for single, $76,500 for MFJ in 2024. You also can't be claimed as a dependent or be a full-time student, but it's a great way to get an extra tax break for saving for retirement, reducing your tax down towards zero.
Any others to quickly mention?
Sure. The Foreign Tax Credit, Schedule 3, line 1. We mentioned it earlier. If you pay taxes to a foreign country, you might be able to claim a credit. There's a simplified way without Form 1116 if it's just interest dividends and under $300, $600 MFJ in foreign taxes, meeting certain rules. And the credit for child and dependent care expenses, Schedule 3, line 2, helps cover costs for child care needed so you and your spouse, if filing jointly, can work or look for work. #TagTagJacker. Payments, refunds, and what you owe.
Okay, we've gone through income, deductions, tax calculations, credits. Now we tally up the payments already made, lines 25, 26.
Right. This is where you account for all the federal income tax withheld from your paychecks, Form W-2, or from things like pensions, unemployment, or gambling winnings, various 1099s, W-2G. It also includes your 2024 estimated tax payments. Crucial if you're self-employed or have other income without withholding. Quick tip. If you made joint estimated payments with a spouse but are now filing separately, maybe due to divorce, you and your ex-spouse can agree on how to split those payments between your separate returns.
Then, the moment of truth.
Yeah.
Do you get a refund? Lines 34, 36.
Hopefully. If your total payments and refundable credits exceed your total tax, you get the difference back.
And the best way to get it?
Direct deposit, line 35. Hands down. Safest, easiest, fastest. And you can actually split your refund into up to 3 different accounts now using Form 8888. Checking, savings, maybe even
An IRA. Can you do that?
Yes. You can direct deposit part or all of your refund directly into a traditional IRA or a Roth IRA. You just need to have the IRA open before you file and let the trustee know which tax year the contribution is for. Usually the year before the filing year. So for a 2024 return filed in 2025, it can be a 2024 contribution if made by the deadline. Crucial point for any direct deposit. The bank account must be in your name or joint name if filing jointly. Double, triple check those routing and account numbers. The IRS isn't liable if it goes to the wrong account because you mistyped.
Okay, what if you don't want the refund now? Can you apply it to next year's taxes? Line 36.
You can. You can elect to apply some or all of your overpayment to your 2025 estimated tax liability. Smart planning tool for some. But warning, once you make that election on your filed return, you cannot change your mind later and get it back as a refund. It's locked in.
And what's injured spouse relief? Form 8379.
This is different from innocent spouse. This is if you filed jointly or due a refund, but the entire refund is being seized to pay your spouse's past due debts, like child support, student loans, or back taxes from before you were married. Injured spouse relief lets you potentially get your share of the joint refund back.
Got it. Now, what if the bottom line isn't a refund, but an amount you owe? Line 37.
Okay, deep breath. Payment is due by April 15th, 2025 to avoid interest and late payment penalties. Though no penalty if the amount owed is less than $1,000 generally, or if you paid enough through withholding estimated taxes.
How can people pay?
Lots of ways. IRS Direct Pay online is free, pulls directly from your bank account. You can use a debit card, credit card, or digital wallet, but third-party processors charge a fee for that. You can schedule an electronic funds withdrawal when you e-file. There's the Electronic Federal Tax Payment System, EFTPS, good for businesses and individuals making estimated payments. You can use the IRS To Go mobile app. Pay with cash at participating retail stores. You get a payment barcode online first. Or the old standby, check or money order payable to United States Treasury, mailed with Form 1040V payment voucher.
What if someone looks at that number and just, can't pay it all by April 15th? That's stressful.
It is, but ignoring it is the worst move. The IRS has options. You can request an installment agreement online, usually for debts under $50, or by filing Form 9465. This lets you make monthly payments for up to 72 months. Interest and penalties still apply, but it avoids harsher collection actions. You might also qualify for a short-term extension of time to pay, usually up to 180 days, by applying online or potentially filing Form 1127 for undue hardship. Interest and penalties still accrue. For severe situations, there's the offer and compromise, OIC, where you might settle the debt for less than the full amount owed if you meet strict criteria. There's an online OIC pre-qualifier tool to see if it's even a possibility. #TAG7, avoiding common mistakes and getting help.
We've covered so much ground. Let's wrap up with avoiding common mistakes and where to get help. What are the simple errors people make that gum up the works?
The IRS sees the same things year after year. Top of the list. Incorrect names or social security numbers, especially for dependents, must match the social security card exactly. Get it wrong, and you'll likely lose related credits like the child tax credit or EIC, and face delays, math errors. Calculating credits, figuring taxable income, the total tax, easy to mess up manually. This is where e-filing is a lifesaver. The software does the math. Also, using the wrong filing status or using the wrong method, tax table versus worksheet, to figure the tax. Forgetting to sign and date the return. If filing jointly, both spouses must sign. A very common oversight on paper returns. Not attaching required forms. W-2s are essential. Form 1095A if you got marketplace health insurance subsidies. Forgetting these guarantees delays. And please, only file one original return per year. Filing duplicates causes major confusion and delays.
Identity theft is always a worry, too. Any final reminders on protection?
Yes. Get that identity protection PIM, if you can. It's your best defense against someone filing a fake return with your SSN. And be super vigilant about scams. The IRS initiates most contact through physical mail. They will not call demanding immediate payment with threats, nor will they email or text asking for personal or financial info out of the blue. Report suspicious contacts. Forward phishing emails to phishing@irs.gov. Check irs.gov identity theft for more tips.
Okay, if after all this, someone still feels overwhelmed or has a complex situation, where can they turn for reliable help?
Great question. Beyond hiring a qualified tax professional, there are resources. irs.gov is the mothership. Forms, publications like Pub 17, the Big Tax Guide, interactive tools like the EITC Assistant, your online account to view transcripts and payment history. It's packed with info. The Taxpayer Advocate Service, TAS, they're your voice within the IRS. Independent help for significant financial hardship due to taxes, or if you've tried to resolve an issue with the IRS through normal channels and got nowhere, they protect taxpayer rights. Low-income taxpayer clinics, LITCs, these aren't part of the IRS, but they get some IRS funding. They offer free or low-cost help from lawyers or accountants on audits, appeals, collection disputes, especially for lower-income folks and those who speak English as a second language. Find one near you on the TAS website. The IRS also has YouTube channels, English, Spanish, even American Sign Language with helpful video clips. And for accessibility, there's a dedicated accessibility helpline, 833-690-0598. Plus, you can request communications in other languages using Schedule LEP.
Fantastic. Wow. We really did a deep dive there. From figuring out if you need to file, picking the right status, navigating income exclusions, finding those above-the-line deductions, and maximizing credits, it's clear that being informed really can save you money and reduce tax time stress.
Absolutely. It's not just about ticking boxes and compliance. It's about understanding the system and using the rules to your advantage, navigating your financial world with confidence. So, my final thought for you, the listener, is this. Now that you have this deeper understanding, what's one specific area of your financial planning? Maybe retirement savings, maybe charitable giving, maybe managing self-employment income that this deep dive inspires you to look at more closely.
That's a great actionable question. Food for thought indeed. Thank you so much for walking us through all that, and thank you for joining us. We hope you feel much more empowered to tackle your 2024 taxes. Join us next time for another deep dive.